Okay, I guess we'll start slowly so that we can have more time with the expert that we have today on the call. So bonjour, good afternoon, and probably good morning to some of you. Thank you for being with us today. Let me start by saying that this session will be recorded, as you probably noticed also on the teams that we have, and so that it will be available for our colleagues that were not able to join us today. So the topic of the conference is navigating insolvency in 2024. This will be a topic that is just on point, probably, unfortunately. I was just reading last week that the Office of the Superintendent of Bankruptcy reported that business insolvency were up by 41% in 2023 compared to 2022. And we are also starting to see it or to see similar trends in our portfolio as well, which is not something that all of us or of the team have experienced or seen before in almost 20 years. So we are very fortunate today to have experts in insolvency and credit risk. So let me introduce you to them. So Roch Simard, maybe we just wave so that people can see. Yes, so I have known and worked with Roch for many years. Our group is at the cutting edge of the credit insurance brokerage industry. So Roch and I have worked together to help our clients review their risk exposure to existing and new clients, and also to help them make informed decisions. Jocelyn Saint-Onge is the Vice President Head of the Strategic Broker Management at Allianz Trade. So Allianz Trade is one of the leaders in the credit insurance solution. Jocelyn is based here in Toronto. And Maxime Lemerle, Mr. Lemerle is the Lead Analyst for Insolvency Research at Allianz Trade in Paris. So we are very privileged to have him with us today. So in terms of logistic and agenda, the format of the session will be a fireside chat. So for the first 30 to 35 minutes, we'll have a discussion with Monsieur Lemerle to help us understand the trend and drivers, if there are specific sector or region that are more impacted or would be, what we are expecting for the rest of the year and in 2025, and how does Canada compare to the rest of the world. So after this fireside chat, we will follow with a Q&A session that will be facilitated with Matthew Baer to address the question that you might have or might still have or would like to deep dive in. You can also use the chat function that we have in the teams that we are used to work with. And it could be bilingual. Toutes les panélistes sur l'appel sont bilingues, vont être disponibles pour répondre à vos questions, soit en anglais ou en français. So on this, passing it over to you, Roch.
Hey, thank you very much. Merci beaucoup, Véronique. And hello, everyone. My name is Roch Simard, and I'm the Vice President of AU Group in Canada. It's a great pleasure and a privilege to have you all here today. And we are particularly honored to be joined directly from Paris by Monsieur Maxime Lemerle, a distinguished expert in the field of corporate insolvencies. Monsieur Lemerle, having you with us today is truly a pleasure.
Well, hello, everyone. It's a pleasure for me to have the opportunity to share Allianz Trade view on business insolvency and hopefully clarify some points and answer some of your or most of your questions.
Perfect. Now let's dive into our discussion. Going back to 2020, when the COVID-19 pandemic hit us, we all thought the worst of time was going to happen. But fortunately, governments around the world took the whatever it takes approach. Now, 3 years later, the same governments have taken that punch bowl away from us. Monsieur Lemerle, could you provide some insight into the trends in insolvencies among Canadian businesses throughout 2023? Like, are there any notable regional differences in how business has fared, and has we've seen an increase in insolvencies in 2023?
Well, yeah, the picture for me is really crystal clear for Canada, with both a major and a broad-based acceleration in business insolvencies. So first, a major acceleration, since indeed last year, the number of business insolvencies posted a double-digit rebound with an impressive 41% surge. And this marks the second year of a substantial rebound following the plus 35% rise posted in the previous year in 2022. So it's true that this upside trend takes place from the historical low levels reached after roughly 2 decades on the downside. But now business bankruptcies have surpassed their pre-pandemic levels, And 2023 bankruptcies are now, or were last year 31% above the 2015-2019 average, also meaning a 13 years high, and record high, indicating how robust is the recovery. So importantly, and that's to complete this global picture, this upside trend is not limited to a specific region, but rather it is a broad-based phenomenon across almost all the 13 regions of Canada. And last year, there was only one exception to this trend compared to what we had 3 exceptions in 2022. So again, this is evidencing the widespread nature of the surge. And Quebec, Ontario, British Columbia, and Alberta have emerged as major contributors to this rise, with Quebec leading the way, ultimately responsible for 60% of the national increase, just followed by Ontario with 30% of the national increase, British Columbia and Alberta with only 4% of the national increase. And those 4 regions collectively accounted for almost, more than 95% of the total number of cases in 2023 last year. And that was a proportion similar to the one posted in the previous years. So Quebec definitely stands out as the outlier with more than 2,200 cases in 2023. And in addition, is representing an increasing share in the national accounts from less than 45% before 2012 and to more than 60% in 2020 or since 2020. So in contrast to that, we have British Columbia and Ontario that have experienced moderate increases of 2 percentage points each since 2020, and their share in the national account, while Alberta has seen a much more marginal decrease of 2 percentage points last year. So now if we compare the region's performance against pre-pandemic levels, it's evident that British Columbia has surged ahead, surpassing the 2015-2019 average by an impressive 55%, followed closely by Ontario at 40% and Quebec at 39%, so almost 40 again. Alberta has shown more resilience so far, remaining 7% only above pre-pandemic levels, while, and that's worth not mentioning, all the other regions remain so far below these so-called 2015-2019 pre-pandemic average.
Okay, we're starting off strong. It's a
41%
increase in insolvency. That's worse than a hard landing. And
definitely,
the numbers of Quebec are a bit staggering. Not a bit, a lot staggering. If we transition from that point, I'm interested in diving a bit deeper in the trends. Could you shed some light on whether certain sectors have been more impacted than others? Are there any industries where the increase in insolvencies has been more pronounced?
Yes, sure, there are, but let's start by the bad news. The bad news is that unfortunately this surge in business bankruptcies has been notably widespread across the traditional set of 20 sectors of the Canadian economy, with no exception last year. So again, signifying the robustness of the recovery in business bankruptcies. While we used to have still 3 or 4 sectors as exceptions in 2022. So if we look more into details, we have 5 sectors that have emerged last year as significant contributors to the national rise. That's accommodation, food services as number 1, followed by construction, retail trade, manufacturing as a whole, and services. Those 5 sectors have not only witnessed a substantial increase in terms of magnitude, all of them with largely above 50% increase on annual terms, but they have also accounted for a substantial number of cases. So on both parts, they are definitely outliers. And when it comes to number of cases, again, we have the same list of usual suspects, I would say, the accommodation and food services, construction, and retail again. Those that are leading the way with almost 600 cases in food accommodation almost, and 500 for construction last year. And an interesting observation from my point of view is that almost all sectors have surpassed the pre-pandemic levels. Again, as another evidence of the strong recovery of insolvencies and bankruptcies across the board. And here we can indicate in particular 4 other sectors: transportation, warehousing, information, and all the cultural industries. The third one will be the educational services, and art and entertainment sectors as the fourth one, all of which have exceeded the 2015-2019 average by more than 50% now. And in practice, there are only two exceptions. We have the mining and oil and gas extraction sector, still 20% below this pre-pandemic average, and the construction sector, which is still just slightly below this pre-pandemic average, but it's noteworthy that construction is really catching up. And last year, construction recorded almost 50% increase in year-on-year terms.
Okay, it's quite striking that almost all sectors, except for the mining and the oil and gas, and maybe a little bit construction, but I understand it's catching up. They're all having significant challenges. That's it's quite concerning. And given this context, I'm very keen to understand what the horizon looks like. We've looked at the past, and what does Allianz Trade see in the future for us in terms of number of insolvencies? How's the trend evolving?
Yeah, let's say that for the short and mid-term horizon, the forecast, our forecast is still on the upside. When we look at the very latest data, they still show an impressive rise. If we look at the last quarter of last year, we already, had a strong. We also had a strong acceleration with a 42% increase on a quarterly base and a 57 increase on a year-on-year basis. So and that all that bring the quarterly numbers to a record high since Q4, since the last quarter of 2029, meaning 56 quarters ago. And this momentum is consistent with the projections of more than 4,000 cases for the full year. Although there is a bit of seasonality, with typically fewer bankruptcies in the third quarter of each year. But however, last year, 2023, was the first exception to this, less a usual traditional infra-annual trend in business insolvencies. And again, we also saw already that January posted a new record high number since almost 17 years, with more than 600 cases. So yes, for this year, 2024, our baseline scenario suggests that the number of insolvencies is likely to reach a 15 years record high, with slightly more than 4,100 cases, and that will represent more than 10% increase again compared to 2023. And this figure that will be significantly above the 2023 average of 3,000 cases. And several factors will contribute, according to us, to this forecast, and that includes including the macroeconomic conditions, such as the weak GDP growth, which is expected to remain below 1% in 2024 in our central scenario, and that's compared to an average of almost 2.5% in the period from 2010 to 2019, so a huge difference in economic momentum. Additionally, we anticipate a prolonged tough financial conditions, with the overnight lending rate currently standing at 5%, not expected to drop below 3% before the end of 2025, representing at the overall a much higher rate than experienced in the past 20 years, just to keep that in mind. In that context, yes, we expect a larger number of cases, notably in the construction sector and all the B2C related sectors, including in particular retail, hotels and restaurants, due to, let's say, the cost of living, the lower purchasing power of households. So we also think that SMEs, the small and medium-sized firms, particularly those established in the last decade, are expected or should struggle the most, especially those whose business models relied on a much lower cost of credit and financing. And if we look even more ahead, looking at 2025, our central scenario as of today is pointing to more than 4,200 cases. That would be an additional increase of 2% year on year. In other words, we expect a prolonged higher level in annual terms. And yes, with a peak expected in Q1 2025, before the start of a gradual improvement that would be supported by a better context in line with the improvement that we expect in our baseline scenario in the macroeconomic and financial conditions for the Canadian economy.
Okay, it's quite concerning, especially in terms of financial impact. But I'm just wondering, like we've talked about the number of insolvencies, which are just staggering, increasing 20 years high. What about the size of insolvency? Because the number, we understand it's going up, but what about the average size of insolvencies? Has this been trending up as well?
Yeah, it depends on the indicators you're looking at, but of course, but your question is, thank you for this question, because indeed the absolute number of bankruptcies are its various realities, just simply because all firms are counting one while when they file for bankruptcy, but they are different in terms of size of, when you look at the number of employees, number of suppliers, and the amount of turnover, the assets, the liabilities, and size matters, of course, when we want to assess the impacts on the other economic agents on macroeconomic speaking. I mean, as a trade credit insurer, Allianz, we are more interested by larger firms and ultimately by liabilities, and that's why we are monitoring these amount in liabilities. And to this regards, we notice that that in an aggregated point of view, liabilities of Canadian firms in bankruptcy was still standing at around 3.7 billion in 2022. Unfortunately, we don't have 2023 figures at this stage, but they are not been released yet, but we expect them to point out to a noticeable rebound. While we, at the same time, we already noticing that the average liability per bankruptcy is definitely on the upside over the last 10 years when we look at the long-term trend, because of course there are some peak and ups and downs in specific years depending on the appearance of a very large bankruptcy. But if you look at trends, over the last 10 years, yes, the average liability per bankruptcy is definitely on the upside. And if we look at the 2022 figures, the average amount is at $1.4 billion. So it means 3 times more than it used to be 10 years ago. And here again, before this average, you have to be careful of the differences between across sectors. With the top largest average amount of liability per bankruptcy in mining, oil and gas extraction sectors at 9 billion in average, which is definitely well above the average of all sectors. Just ahead, finance insurance at $8 billion, agriculture at 6, the management of firms at 5, and real estate at 4. So you see, if you're involved in those sectors, definitely the story can be different. And by the way, coming back to the comparison of absolute numbers, I would encourage the actors to put them in perspective to the number of existing firms, and in a more positive approach also to business creation in order to monitor not only the insolvency numbers, but also the insolvency rate. I mean, by dividing the number of insolvencies by the number of firms for each given sector or each given size of firms, depending on what you want to monitor. And that's in order to get the complete picture of the insolvency, not numbers, but insolvency risk in relative terms. And put it simply, the higher the number of existing firms, the higher the basis for insolvency number, everything else being equal.
Yeah. Okay. If I understand correctly, the number and the size of bankruptcy is on an upward trend, which is not really good. But is this unique to Canada, or as Allianz Trade seems similar patterns globally? Like, is there some normalization ahead of us? Is there some relief? Is there some positive news coming up in the future as well?
It depends on the horizon for the future, not for the short term, unfortunately. But no, Canada is not a unique or a special case, which can be seen by some as somewhat reassuring for Canadian firms, but which for us is more a source of 2 additional risks for Canadian firms, even if they are not all impacted the same way. I mean, on one hand, we have a risk of non-payment for exporters, but also on the other hand, we have a risk of supply chain disruptions for Canadian importers, not exporters, but importers. Because indeed, and as expected, last year we saw a high speed and broad-based rebound in business insolvencies globally. You can retrieve all the figures per country in a special report that we released 3 weeks ago. But the key points of this study was that for the last year, 2023, we found that 3 out of 4 countries posted a rebound with almost 30% increase in average. That was the fastest momentum since the great financial crisis. We found that exceptions were mainly in emerging markets. I think about the BRICS, but also Spain, and all those together accounting for a large part of our headline, our global insolvency index. So that's why those small number of exceptions lead slightly on the downside. The Allianz Trade Global Insolvency Index, we finally handled last year with a 7% increase, only from a 1% increase in 2022. But that was, also means that 2024, this year started with insolvencies already well above the pre-pandemic levels in most advanced economies, with the US, which is an important country for Canadian firms, but also Germany and Italy as notable exceptions, even if all those three countries are also catching up. That's why we expect at a global level another acceleration in 2024 for our global insolvency index. It means a 9% increase. And our expectation in the baseline scenario is to have towards a stabilization at a high level in 2025. But a stabilization in average doesn't mean that we will not see some countries still posting an increase in insolvencies in 2025, according to our central scenario again. But yes, for sure, it's true also that we expect a large number of countries starting to see a decrease in insolvencies from the high level that they are about to reach this year. To make it short, we expect 4 out of 5 countries to see a decrease in insolvencies in 2025.
Good. Finally, some good news. So we're going to see some normalization.
2025.
But yeah, 2025. So we'll see each other in 2025. But in the meantime, from now to 2025, what would be the 5 key challenges for entrepreneurs? Like, what should the BDC consider in their analysis in terms of challenges that will be faced by those entrepreneurs?
Well, let's speak at a global level. Maybe easier for me.
Yeah.
You better know than me, Canada, for sure. I know that on that. But at a global level, yes, and that's what is behind our forecast per country. We are considering 5 main challenges that we think will make this year, 2024, a year of reality check for global firms. For firms globally. First, we think that the risk of a profitability squeeze is still well in place. We have the US, but not only the US, but I think the Eurozone and most emerging markets, including China, by the way, that is to face below trend GDP growth, and that will increase the pressure on profitability at the time of still high operating costs, with little relief from energy prices, first from continuing wage growth, and from lingering supply chain pressures. Think about the Red Sea of the Panama Canal. That's the first source of concern. The second one is that we see uncertainty still on the rise, from geopolitics to rising non-employment risk. And this is adding 2 things. The first one is a layer of complexity and risk to entrepreneurs' operations by making it harder for firms to make accurate forecasts and plans and business plans. And the second thing is that this uncertainty is also supporting volatility in input costs and ethics. And that will make it difficult for firms to effectively manage their supply chains and all those budgeting process. At the same time, we expect, and that's the third point, financing and liquidity conditions to remain, that's not a surprise, I guess, for you, to remain tight. And that will maintain concerns over the capability to absorb the cost of borrowing. And at the same time, the limited availability of financing will put the most exposed sectors, the highly leveraged ones, for instance, at risk, while we know that we still have a pretty high number of fragile firms in many, at least European countries. We made a special research on what we call internally the fragile firms. It's not exactly the zombie firms, but something rather similar. And the support given by the governments in Europe has not dramatically improved those insolvency, share of fragile firms, according to our calculations. The fourth point is that we think that this year is time for is a reality time, is the first real resilience test for all the firms that have been created since the pandemic. We saw in many countries, especially in Europe, I must confess, I don't know for Canada, but maybe it's the case, yes. But I know that in Europe, we see a huge wave of creation of businesses after the pandemic. And there are a lot of studies showing that in the first 3, 4, 5 years, the insolvency risk is much higher than for the older companies. It means that we expect a kind of extra additional number of insolvencies just coming from those, this huge number of new firms created in the past 5 years. And last, the fifth point is that we know that also that's for structural or for cyclical reasons, we have some sectors that are more exposed to what's going on or to what is expected economically speaking this year. I think about, again, hospitality, transportation, wholesale, or more precisely retail. And I think also about the construction and the real sector, which are definitely about to boost national number of insolvencies in many countries, not only in Europe, but especially in Europe, where we know that historically speaking, we have at least 20% of national insolvencies that are in the construction sector, just because of the business demography of this sector, with a huge number of very small companies, very fragile.
Yes, these are absolutely 5 very key points to consider. But getting back to Canada, like 75% of our Canadian exporters exports to the US. On top of those 5 key challenges that you just highlighted, what should Canadian exporters to the US be mindful of? Is there any specifics in the US that you could share with us?
US is not a special case. I mean, we do observe last year an increase in insolvencies, definitely, as well as a return to a pretty large number of large firms filing for bankruptcy. So it was a 30% rise, if I'm not wrong. We still expect a noticeable rebound this year, so a prolonged increase or prolonged rise in insolvencies. We expect something like 28% increase this year. We expect this to continue next year, 2025, with a slightly lower, much more moderate increase at 2%. It means overall that we expect a return to more than 24,000 insolvencies per year. So it will be slightly above the 2016-2020 average, but it will be still a low level from an historical perspective. Just remember the 2020, in the last 2 decades, it was above the 30,000 numbers or threshold. It was above the 40,000 threshold in the previous decades before. So definitely not a high level, but the upside trend is definitely there. It means that some sectors may need to be much more careful when doing business with American firms. But the background is slightly different because, as you may know, I guess you know, in the US, firms have accumulated a huge amount of buffers, and they've been able to build solid balance sheets. One key reason being the fact that they benefited from a massive transformation of the government guaranteed loans of the Paycheck Protection Programs into subsidies, meaning that they don't have to reimburse for this major amount of money. While it's not the case, well, it's completely different in many other countries in Europe, but not only Europe, and I think it's partly the case also in Canada.
Okay, that's quite interesting. For the people at the BDC, are there any macro or individual indicators that they should be focusing on? I mean, what should they be looking at to help them mitigate the insolvency risk going forward?
Well, it depends on your position and what your job and your mission. But as you said, roughly speaking, there are at least 2 kinds of indicators. Yes, there are macro indicators, and more importantly, I would say the macro forecasts. They are key for understanding and anticipating the global context, the global forces, the fundamentals that will benefit or commercially pressure the firms. So it's key, yes, it's key to anticipate the changes in the fundamentals, being economic, being financials, or in terms of policy, or in terms of regulation that have the potentials to increase or decrease insolvency risks due to their impact or potential impact on the demand. I think about the turnover of firms, of course, or the profitability or liquidity of firms. So at Allianz Trade, our business insolvency forecasts at national levels are mostly based on models using GDP, unemployment, financing conditions, financing availability, by mixing levels, trends, and differences and different lags. So it's not a bottom-up approach, not at all. And of course, behind these macro figures, there are of course some winners and losers, better and worse performance. So of course, if you are more interested by individual cases, as a credit analyst, as I used to be several years ago, by the way, you will look at the individual performance, the financials. You will benchmark the financials with the apparent peers, even if it's sometimes difficult to find peers, a perfect peers to have a perfect comparison, a perfect benchmark. Eventually, you will also compare those findings with, let's say, so-called predictive indicators. I think about a study that we released 2 years ago when we met, where we were mentioning 3 indicators and their thresholds that appears to be an early warning for an insolvency at a 3 years horizon. Well, unfortunately, Canada was not part of the panel. Sorry for that. But we found some indicators that was pretty interesting to look at in a midterm perspective, as they were predictive enough as key factors that could implicate or turn to insolvency of individual companies. But that's for the financial things. I would focus also or say a word on the non-financial indicators that are, from my point of view, more than helpful, especially when you are able to detect changes in individual habits of companies, since they can be early warning signals of difficulties in between 2 financial releases. The classic example, or one classic example, is the unusual or unexpected lag in the date of releasing the financial sheets. Of course, another classic example is all types of issues related to payment practices with suppliers, or to delivery practices to clients, or to change change in your bank, or in firm's bank, sorry, or huge change in inventories that you may be able to find for this company. So those are non-financial indicators that can be very useful and be early warning signals. This is why credit insurers, but not only credit insurers, but factors have a comparative advantage, since their position allows them to access and mix a very large variety of information. And that definitely helps to do some, let's say, scores and other types of indicators, predictive indicators.
Yeah. It wouldn't be a good interview if I didn't put big data and artificial intelligence in the questions, because it is the subject of the day. And Allianz Trade, being part of the Allianz group of companies, I would assume, without revealing any secrets here, that big data and artificial intelligence could play a role in predicting the insolvencies, or am I getting ahead here?
No, you're definitely right. Machine learning is definitely, if not a game changer, not yet a fully game changer, it's at least already an impressive technology that allows us to improve the existing models. And that allow us also to create new predictive approach, to have new predictive approaches, simply by supporting the data crunching of massive set of traditional, and more importantly, of new types of data. And there's, almost no limit to that, except IT resources. On our side, for instance, we have developed a regime change models to forecast 6 months ahead, small and large shifts in insolvency, to secure our classic model just by using thousands of decade-long macro financial data series. So for some key markets, of course. And we have, of course, at Allianz Trade, not on the research team, but the in the risk teams, dedicated teams working on consistently improving the accuracy of the probability of default that are used in our system, using machine learning to more easily compute the historical probability of default by, again, mixing all types of financial and, more importantly, non-financial indicators, such as, the creativity is large. There is no limit again. So the age, the localization, the sectors, the payments, the historical of payments, everything is possible.
Yeah. No, that's quite interesting. But and what about the entrepreneurs, like the SMEs of this world? They don't have access to this big data or the artificial intelligence. Are there any strategies that they could integrate into their operations to plan ahead and help them in the upcoming 2024-2025 spike in insolvency risk? Is there anything that you could tell us that they could put in place?
I would say I have no lesson to give to entrepreneurs. Of course, they are doing they have a tough position. They are doing their best, and it's not easy. And they already, many of them succeed a lot in surviving the COVID period, and so they did a great job. But yes, unfortunately, the risk, the credit risk is back. And I would just say that it may be good to remind that companies can turn to, let's say, a variety of strategic measures to fortify their defense and mitigate the impact of rising insolvencies. One could be the diversification of the client bases and the supply chains, just in order to reduce the dependency on a single or on a too low number of markets and suppliers. But the objective, of course, is to increase the resilience. That's more easy to say than to do. I know that, especially for specific products and services, I think about very critical material that are delivered, provided by a few number of firms. So easy to say, not easy to do, but that's something that needs to be reminded. The diversification is always something to keep in mind and to try to implement as much as possible. The second idea could be to adopt a kind of, let's say, proactive approach to risk management. Firms can identify their efforts to assess, to monitor, and to mitigate financial risks through prudent measures. I think about enhanced due diligence on potential partners. I think about rigorous credit evaluations. I think about the establishment of stringent credit policies, and this can be done internally, and this can be done with the support of partners. To this regards, a key point for me is to be sure that the risk takers are well informed, especially when risk takers do not have the experience of past episodes of tough times. And for me, that's something maybe more important for Canadian firms, since Canada has been successful in having a 2-decade trend of declining insolvencies. So one key question could be how experienced how informed are all the risk takers of this ongoing trend reversal, and how are they prepared to handle with this upside trend, which is for most of them something new, and while they may have not experienced at all in this type of trend.
Yeah, if you've never seen or experienced, if you've never seen it, never experienced it, you don't know how to react to it. And
I'm not saying that I'm not capable. I'm just saying that, it's something that might be new to a majority of risk takers, and so it needs to be, to be sure to do whatever is necessary to be sure that, well informed, well trained to take whatever needs to be implement in face of this new environment.
Yeah, no, absolutely.
Last point, if you need real-time financial protection, I'm not a marketing or sales guy, but you have credit insurer, and not only Allianz Trade.
No, absolutely. This is not a sales pitch for credit insurance
No,
or
no, no,
anything,
no.
but of course, credit insurance can help mitigate those losses by only accessing your huge database and huge systems. That's one way of going about it, for sure. So we want to have enough times for Q&A, unless there was anything else that you wanted to add now. I would switch to the Q&A portion of this conference. It's been very, very informative so far. And yes, there will be in 25, maybe 26, a way back to normalcy, but that means an increase in insolvencies. And the good thing with this conference, the BDC is now aware of this, and they can act on this and inform the entrepreneurs and have an active role to play and prepare themselves for the upcoming insolvency. And what's great, there are solutions that exist. So that's perfect. Jocelyn Saint-Onge will join Monsieur Lemerle and I for the Q&A portion of it. And I believe, Matthew, I was wondering if you had any questions that popped up that you would like to raise and ask Monsieur Lemerle about his ideas on that.
Well, I'm going to be selfish first. I'm going to ask my questions, I think, before asking any of the other ones. So first of all, thank you so much for that. I thought that was extremely interesting and very, very helpful. And it's very nice that we're not the most depressing people at the table for once, which is good, because we hear some depressing news here. But nonetheless, I think it's very important, valid, and ones that we have to address. If I could ask you this, you gave a lot of very clear and important macro information. Could we dive a little deeper on the micro? So there's a couple of industries that you mentioned that have particular issues that we're seeing globally. Can you speak a little bit to transportation, retail, let's say the warehousing, like you had said, hospitality, just to give us a little more indication of the type of insolvency and what we're seeing and what the actual pressures on these businesses are?
Well, if I start by the, definitely all the B2C sectors, sorry, are under close list, close monitoring at Allianz Trade, just because they are part of the firm that benefited the most from the government support in many countries. So that's, also why they are rebounding so much in so many countries, because now there comes a time when they have to reimburse the support they have been received during the COVID period. But this is happening, at least in Europe, in a time when the financing cost is higher, when the demand side is have really started or is declining, weakening a lot. So the pressure on the profitability is higher. So meaning that the room for maneuver for being able to reimburse is much lower than previously expected or anticipated at the time when they were strongly. They were looking very quickly to have more support. So this is a kind of catch-up, or slightly more than a catch-up effect, which is natural, but which is huge because they benefited a lot or the most, at least in Europe, from their government support. And since in Europe, at least again, sorry for focusing on Europe, but since the household environment is definitely weaker than it used to be last year and is suspected to remain the case the whole year, we are about to see not a tsunami of insolvencies in a B2C, but a pronounced high number of insolvencies in these B2C sectors, including notably the hospitality and tourism, because at the same time they are facing very specific, pressure. Again, that's the case in France, but everywhere in Europe in terms of cost pressures. The pressure on the wages in services in Europe is definitely high in sectors where that have been deeply affected by the COVID-19, and people prefer to move to another job, another position, and this is a labor-intensive sectors which are, struggling the most from these switch in labor forces that are driving up the pressure on wages, and so the pressure on the profitability on the companies of those sectors.
And if you speak to transportation specifically, do you have any insight there?
On the transportation sector, I would say, sorry, not to answer that question. It's one of the sectors on the closed list. Again, much more for past reasons due to the spike in energy prices in the last 2 years. We still expect, in our case, central scenario, a barrel at around $80 more or less this year and next year, by the way, more or less $1 or $2. So it's not dramatically different from the consensus, but it still means a higher level compared to it used to be a few years ago, and what it used to be in many business plans. So meaning that many firms have, if it has not been done yet, to adjust again to this forecast outlook of a prolonged higher energy cost. But again, you said transportation. The key point for me is that transportation is about so many different types of businesses. I mean, there are huge differences between road transport, maritime transport, airlines. So yes, we do sector risk ratings on top of insolvencies, but one key issue is that we are mixing so different stuff that the average for me, I'm sorry to say that, but it doesn't mean anything. We should have a more closer view and distinguish again the road transport to the maritime and to the railways. They have their own challenges.
Thank you. That was great. On the call, you have people who are from credit, underwriting, business restructuring, special accounts, many of whom have never experienced a true downturn or real pressure. So it's been more, they've at least professionally grown up in more of a positive environment. What advice would you give, considering your previous experience as well as your experience now?
Yeah, hard to give lessons. I'm not. I don't want to call that lessons, because I have to confess that forecasting insolvencies in Canada has always been really difficult for me, because all the models we have here in Allianz Trade for many countries simply, does not work in Canada. In other words, we never find a way to have a good forecast for Canada and for insolvencies in Canada, because we have often been surprised by the resilience of the economy of some such sectors that are key for the total account of insolvencies. So the forecast that we do have for Canada, even if it seems kind of obvious that the upside trend is there, and macroeconomically speaking, all that makes sense, but the accuracy of the figure, to be honest, is very hard up to now for Canada. So just to say that, Kenya seems to continue to be, for me, a very unique case, not in the sense that they are showing different trends, but in the sense that it's very hard from Paris, here in France, Europe, to have a correct comprehension and understanding of what's going on in your country. So if I were to replicate what we do, what we are looking at here for European countries, I know that it doesn't work exactly the same way or with the same good result for Canada. But look at the macro trends. Yes, as I told you, it's very important to have a good understanding of the global context. But that's just for the starting point. The key point is to look at companies one by one, again, to do some benchmarks as much as possible, to look at peers, but to understand why the individual case may be much more better or worse than the average of the peers, just because there are some differences that are not obvious, because they are just selling different products, selling slightly different, giving slightly different services, that ultimately leads to another market, or a market of niche, which by itself explains the differences in the overall, in the ultimate financials. So the idea is always to navigate between the macro view, the global context, and the specificity and the granularity of the things being at a sectoral or by countries. And to distinguish the average and to look at the dispersion, we do many researches, on working capital requirement, DSOs, DPOs, and there are a lot of things. Even in solvencies, we are talking about average, absolute numbers, but in terms of risks, what is more interesting and what we're doing internally is to look at the dispersion and the changes on the dispersion around this average, the worst 10%, the better 10%, and to see if they are representing more or less of the global picture. Let's say that the global picture is good for communication, but for risk purposes, the devil is in the details, and the top worst and the top worst in the case of risks.
We have a modeling team on the line also, so I'm sure offline we could have an incredible conversation on this topic, but we'll leave that to another time. Just a couple more questions. One more of mine. I've tried to gain a better understanding of what's the catalyst to cause some more of a positive, what's going to lead us into the 25 switch, where we're going to start seeing things start to take the turn. Is there a catalyst that you're expecting, or is it just progressively we're going to see things start to settle?
No, that's our baseline. The gradual improvement, the macro improvement and financial improvement is for us sufficient enough to lead to a gradual turnaround on the positive side. Even if the momentum, the economic momentum is not, so magnificent, I would say, in 2026 horizon. I looked at the consensus for the Canadian GDP growth. It's not, as it used to be several years ago. Even on the financial side, the expectations in terms of overnight land earning, yes, it will be lower, but not as low as it used to be. And again, as entrepreneurs used to have when they were happy to create a new business, when they were thinking about doing something new, they are not used to this level of leverage or interest rates, and so they have to find maybe another type of financial structure to make their business profitable. And definitely, this is a new financial context. I'm not sure that a lot of businesses that have been created in the past 10 years remains profitable enough if the people don't have that in mind and don't do the adjustment that are needed to remain afloat. That's what we call the fragile firms internally. And we see this number that kept on increasing in the UK, France, Spain, despite what has been done by the governments to support, to help, the companies to survive to the pandemic. Sorry.
Thank you. We have a great question, but one that's specific to the Canadian market. But it'd be interesting to see. Recognizing you might not have the background there, but if you could answer to the best of your ability, it's with regards to the real estate sector, and we're looking for an indication. Do you see a significant increase in insolvencies, more on the investment side or the income property owners? So, are you seeing continued strength in the sales and leasing activities in the commercial industry?
I have no idea. To be honest, on this specific segment, I cannot reply to you. I can come back to you on that point. We have a team member working on the construction real estate. I can come back to you on that.
That'd be. We're primarily we do a lot of real estate type back lending, so I think that's one of the reasons why we just have a particular interest. So thank you for that. Last question, just if I could, again, recognizing that you can't go into more detail for the Canadian market, and then the forecast I think that you give us a good indication of where we're going. My biggest concern with everything you talked about is this continuing profitability squeeze that we're going to see. And when we deal with our clients on a day-to-day basis, I'd like to give everybody a little bit more indication of how we can help more, like what we can do. And I'm not talking about the insurance side. I'm talking more, what kind of questions do we ask and guidance can we give them in order to be able to support? You addressed this partially, I think, when you were originally talking, but any more thoughts that you have around that?
I would say to support them in reassuring them in the fact that the business that they are doing will definitely comes with will be transformed into a real turnover. I mean, the idea is just to avoid, the insolvency risk of their clients. To help to support them in having less insolvencies of clients, just to secure their top line. That would be, because the rest, I get they know, they better know than us, their strategies, their business plan, and so on. But there's something that is maybe different, or is human resources consuming, is the monitoring of your turnover. The effective turnover. It's good to have sales guy going over the world. In many cities and regions, and to sell. But to do this, do those sales are they transformed into effective turnover, or into effectively transformed into turnover? And that's the risk, is that it's less the case, slightly less the case today and next year, due to this increase in insolvencies. So, and the story is not only about insolvencies, by the way. Maybe good to have another point of view on that is, on top of the insolvencies and bankruptcies, we also have all those restructuring going up also in Canada. And so maybe a good idea also is to not only look at insolvencies and bankruptcies, but also to add to this type of monitoring, the monitoring of restructuring, especially when they involve, I don't know exactly how they involve firms, legally speaking, in terms of liabilities and assets and so on, but that's something that also have an impact, or may have, or could have sometimes a huge impact on your own businesses. So that's something that should be added to the monitoring of the insolvency risk. I would add a restructuring risk, especially in countries where when there is a return, definitely on the economic momentum.
I find that very helpful and very telling for us specifically. We're a development bank. We're there to support our entrepreneurs, but at the same time, we have to make sure that they have the right operations with the appropriate top line, and that we're not giving too much debt, and that they're able to support that debt, which I think also really would help greatly. I have a list of about 50 more questions. I will stop there, though. This has been wonderful. So it's exactly what we were looking for in terms of information. So thank you all for addressing it. Véronique, do you want me to pass it over to you to any closing, or Roch, for any closing statements?
Yeah, absolutely. Thank you very much, Matthew, for your time and questions, quite enlightening. What we will do further to this conference is Allianz Trade has just recently published a global insolvency outlook. So we'll push that to Véronique, and she will distribute that internally. And most of what we've looked at today is dealt in more details in that survey. But if you have any questions, please feel free to bring them back to us, and we'll make sure that we address them. But time is running out. We have one more minute before we leave you and go back to your journey to help Canadian entrepreneurs. But before we do, Monsieur Lemerle, thank you so much for sharing this expertise and insight with us today. Was really enlightening, and we really appreciate your time, especially at the time you are at in Paris. So we greatly appreciated that. I want to thank all the participants for joining us and engaging with such thoughtful questions. So great. Thank you very much for that. And finally, a special thank you goes to Véronique, Matthew, Etche, Simon, and the entire team at the BDC for facilitating this wonderful opportunity for us. Thank you. We hope this session was informative and that it has provided you with valuable solutions to help your entrepreneurs through the challenges ahead. And with that, I say you goodbye to everyone. Enjoy the rest of your day, and talk soon.
Thank you.
Thank you.
Thank you, everyone.
Thank you,
Thank you, everyone. Bye-bye.